Okay, good morning, everyone. We'll start now since it's already 11:15. So we'll have some company results as well as sector updates. First up is SIA Engineering company, which announced their results last Friday. So we maintain neutral with a lower target price of 266. Our previous target price was 281. We have lowered our FY19 earnings estimate by 3%. Forecasted dividend is 11.5 cents, and that will give you a 4.6% yield based on last Friday's close of 252. Revenue-wise, in the table, you can see it's lower by 5.6% year-on-year for the quarter. Same reason as previous two quarters, lower airframe and fleet management revenue. So what's going on for lower airframe is that because of the newer materials used for aircraft, they are more durable, and so they require less maintenance in the hangar. And then for fleet management wise, there's also a structural change in how this service is being provided. Now, this service is packaged together with the aircraft OEM. So that's why SIA EC is experiencing lower revenue from this, and some of the contract for these services will start to appear in their associated company instead. So for company EBIT wise, is down by 15% because of the lower revenue, and however there was lower OPEX, but OPEX was only 4.8% lower, so this was not able to offset the lower revenue. And then EBIT margin is also been compressed to 6.2% from 6.9% last year. Associates and JV wise, you can see it's lower by 53%. Take note that for earnings contribution, associates, if you look at last year, was 40 million and EBIT is 19 million. So associates and JV actually is the larger contributor to overall group EPS, and EBIT is only half of the associates and JV contribution. So this year in 3Q19, associates and JV took some one-time hit of almost 20 million, and so it's been halved, and that's the main cause of the lower PATMI this year. So this year PATMI is down 40%, mainly because of the lower share of profits from associates and JV, and then consequently the margin also being compressed to 12.9% from 20.4% last year. So positives wise, not much of a big deal. It was a lower material cost. Most of the cost savings came from the lower material cost, and this was in line with the lower workload. Whereas negatives wise, as I mentioned, core company EBIT continues to weaken. This is from the structural issue of the airframe business as well as the fleet management business. Also, there was the negative surprise of 53% year-on-year lower and 36% quarter-on-quarter lower profit from the associate and JV companies. This was mainly due to one-time events. There were three one-time events. First is the revision in fee structure for their engine shop, and then there was a foreign exchange adjustment due to change in functional currency of an associated company, and lastly there was a tax charge booked for certain associated companies arising from restructuring. So outlook for SIA Engineering is still negative. The core company operations remain challenged by longer maintenance intervals and lighter work content. And also after we've seen these restructuring charges for the associates, we're also cautious of any other further negative impact from other restructuring of other associated companies as well. Okay, so now we'll move on to Alvin, who will talk about M1.
Thanks, Richard. So for M1 results, it's largely in line with our expectations. Operating revenue grew 4.03% year-on-year. For the positive, there's higher fixed services contributed by increase in fiber customer base and corporate projects. Negatives is that M1 actually lowered ARPU for market share. So ARPU actually declined 4.3% year-on-year. As a result, M1 along with Circus Life, its MVNO partner gained 92,000 subscribers, and that's a 7.12 year-on-year gain. So we do not think that this is sustainable in the long term. So net profit was largely due to weakening margins because of lower ARPU, and EBITDA is in line with our expectations. So we view that shareholders should accept the VGO as it is an opportunity for shareholders to realize their investment at a premium to current market price. So M1 is most exposed to the entrance of TPG and increased competition from the rise of more MVNOs, as 80% of its revenue is derived from the Singapore mobile market. The close of the offer is on 18 Feb 2019. So with that, we have a neutral recommendation and with a target price same as the offer price. So this is taken from the M1 offer doc. These are the peers, regional peers that derive the M1 offer price of $2.06, and this is in line with the industry valuations, except the PE is at the low side of 13.9 as compared to the total mean of 18.2. So with that, I'll pass it on to Ming Ying to talk about Singapore Bankly.
Hi, so this is the Singapore banking sector for this month. It's released on the 1st of every month, so it's an update of the banking statistics. So for Singapore's loans growth, it continues to slow, and we can see that it's mainly due to the consumer loans. The red line is the consumer loans. It weakened to 1.5% year-on-year, which is the slowest in 12 years. And this is mainly due to mortgage loans slow down to 2% year-on-year after peaking in May 2018. And this could be due to the property cooling measures as well. And as for the Singapore's December domestic deposits, it grew 3.5% year-on-year, and this is the fastest in 12 months. And this is mainly due to the growth in fixed deposits at 10.5% year-on-year. So as you can see, the red line is the fixed deposits, and it's growing much faster than the current and savings accounts, and is the main driver of deposits growth in Singapore. So this is mainly due to the bulking out of the banks in the fixed deposits as well as the government and the treasuries, and mainly due to the bulk up that we have seen in the banks that actually compressed their net interest margins in the previous quarter as well. So moving forward to FY19, we should see that as the banks gradually, progressively release these deposits that they have garnered into loans, we can see that net interest margin should reprice accordingly. And this brings me to this chart here of SIBOR and SOR and your bank saving deposits rates. As you can see, SIBOR and SOR has been growing exponentially in the past year or so, and savings deposit rates of the Singapore banks has remained relatively stagnant. So this gap that we see that is growing larger and larger is the net interest margin that we want to see in the bank's results. So moving on to Hong Kong's residential sale and purchase value and volume. Hong Kong's December loans growth recovered to 4.4% year-on-year. And Hong Kong's property market continues to slow in December with both residential sales and purchase value and volume contracting respectively, both month-on-month as well. In January, SIBOR for Singapore reached 11-year high at 1.89%, and this is up 0.54 basis points month-on-month. So as loans for the banks take around months to years to reprice, we will expect net interest margin to continue even if there's a pause in the US Fed rate hikes. So we maintain the Singapore banking sector at overweight and continued net interest margin expansion and rising dividend is both a share price catalyst in the next 2 quarters, and dividend support of almost 5% for the 3 banks. We also expect slower loan growth for UOB, DBS and OCBC around 6 to 7% in 2019 as compared to 8 to 9% in 2018 that we have forecasted here. And this is mainly due to property cooling measures, rising interest rates, as well as global slowdown, and also headwinds in loan demand in Singapore. So the long-term trend of net interest margin expansion should offset some downsides in the loan growth that we will see in FY19. So the bank results will be released on next Monday for DBS and next Friday for both UOB and OCBC. So now I'll pass on to Edmund for the US Weekly.
All right, thank you, Min. So right now I'll be covering the US Weekly. So firstly, for the macro last week, the ISM non-manufacturing index fell more than expected in January. It fell from 58 in December to 56.7 in January, while the consensus was 57.2. So as services represent 90% of the US GDP, a fall in the index signals that the economic growth is slowing. So for the public administration and the construction sector, customers are apprehensive of the overall economic conditions. And this is further worsened by the government shutdown. The US trade deficit also fell in November for the first time after 5 months of increase. It currently stands at 49.3 billion as compared to 55.7 billion in October, which represented a 11.5% decline. And this is largely due to a slide in the imports of household goods and petroleum. So the total exports edged down 0.6% month over month, while total imports was down 2.9%. In particular, imports from China fell 6.41%, and it is possible that some of the consumer goods and petroleum imports were brought into the country in greater numbers for the past 5 months to build a stockpile before the import tariffs took place, or it grew even worse. However, we believe that it's likely that there's going to be a trade war due soon, and even if the trade war deal falls through before the March deadline, the US is likely to extend the March deadline because a further escalation of the trade war will likely have a huge impact on the US economic growth, and this will not bode well for Trump's 2020 elections. As for the corporate news, Google reported better than expected earnings. EPS was 15.7 as compared to the consensus of 13, while revenue was 31.8 billion, while the expected revenue was 31.3 billion. Actual CapEx was 7.1 billion, and it is much more than expected because it was due to the growing investments in cloud computing and AI. Although Google has lower operating margins due to the increase in cloud spending, we believe there is still potential upside as all of its segment revenues were up. Although Google is currently the 3rd largest cloud service provider, it trails far behind Amazon and Microsoft, so it is currently investing heavily to build up its cloud expertise with a focus on its value proposition, which is AI and machine learning. It is likely that the growth of its cloud segment will likely drive its earnings growth moving forward. As for General Motors, It beat the EPS earnings estimates. The reported EPS was 1.43, while its revenue was 38.4 billion. And the results were mainly helped by the pickup in the truck sales, which are a profitable and growing share of GM's product lineup. It rose 3% year-on-year in Q4 2018. But it still represents a smaller proportion of its earnings as compared to its main line of mid-sized cars and SUVs. So the vehicle sales trend was down 13.5% in Q4, and the company has a high exposure to the slowing China market. Furthermore, as the interest rates rise, new auto sales is expected to slow as car loans become even more expensive. So for the week ahead, some of the key indicators to be released will be the core inflation rate, the retail sales month-over-month, and the University of Michigan's consumer sentiments. So this is the list of the upcoming earnings release, and I will leave this page on for a while for you to see. As our China analyst is currently not around, so maybe I'll just go through the slides. Okay, with that, we have come to the end of our webinar, and we'll take any questions. Hi, so I'll answer some of the questions. So there's a question on whether there's going to be a market crash this year. We do not foresee that there's going to be a recession this year. And we have a list of 17 Phillip recession indicators. And based on it, most of the indicators are still not indicating any possible concerns for now. And the US economy is right now in the late expansionary cycle. So we will still see at least one more year before there's going to be a downturn. Then there's another question on whether there's any stock recommendations for the US market. So recently, we published a report on the cloud computing sector. So the three stocks that we have recommended would be Google, Microsoft, and IBM. For more details, you can refer to our cloud computing report. You can go to Stocks PNB to browse all of our market reports.
Hi, there is a question asking about the outlook of Ezion and its current position in this challenging O&G environment. So we already seized the courage on Ezion, so we don't have any comments on Ezion. Thanks.